Markets were relatively calm today, so let's jump in, take a look. This will be a quick one today. We didn't have anything significant happen since the whole Terra Luna situation and all of that. They're trying to figure out what to do, whether or not they can revive the UST, kill it, keep Terra going, all of that. So be interesting to see how that works out. Markets basically flat today, except for the NASDAQ. NASDAQ was down 1.2%. S&P down 0.4%. Dow Jones finished kind of flat, and no real major news to talk about. Musk is still playing around with the Twitter deal, deciding, is he going to go? Is he not going to go? Things like that, and obviously a lot of talk about the, Terra situation. And, Michael Burry is back. He's betting against Apple because there's a lot of talk about Apple out there. And if Apple takes a tumble, that'll take the NASDAQ with it. So let's jump into the charts real quick. And this is Bitcoin on the hourly, still kind of consolidating, working its way in an upward kind of a channel since that $25,000 low that it hit the other day. Kind of bounced off of that, had a nice 20% reaction, just been kind of bouncing around in this channel. And as you know, trend lines are useful in terms of entries, exits, breaking out, breaking down, those types of things to kind of keep an eye on. And we were watching a macro channel earlier on the daily that kind of resembled this a little bit, but this is more of a wedge kind of a thing going on here. Again, these are hourlies right here that I'm looking at. So not critical, but it can tell you a little bit about what's going on in some of the hourly action here in terms of price revolving. And generally, if it's a rising channel, boom, that's what you see. So just something to keep an eye on there. Potential for that happening, not that it's going to or it will, but a lot of times these rising wedges and things like that work out that way. Let's take a look at the daily. And what Bitcoin has done here is put in another lower high. So still working its way down, lower highs with lower lows. Of course, the lower low taking out that macro low, or at least coming real close to it right there at 28.7. So I guess at 28.7, it was a weak closing there. It got bought up quick off that 25,000 level, but still took out the last low over here in 2021 or right at it. So this level here is highly contested, a lot of support. So Bitcoin is going to continue to work its way out with that. So let's take a look at it on the weekly. And again, a lot of people talking about this 7 weeks down. First time in the history of Bitcoin that it's closed for 7 straight weeks down on the weekly. So that's obviously not a good sign. And what we've been watching is this 200-week moving average. And every time price is broken below the 100, it always checks in at the 200. The question is, where is that 200-week level going to be once the price, gets there? And the more it kind of tags along sideways here, the more opportunity for this level to rise. So potentially coming in right around that $25,000 level. And the only time we ever saw it go below that 200-week moving average was on the March 2020 pandemic, and it wicked below briefly about, well, it was about 27% down from that level. So if price were to break that on a wick basis to 27%, that puts it down around 15,000. And there's been, a couple of people out there talking about those $10,000 to $15,000 levels right now. This is a big level here at 30,000 where price has been kind of holding up, but that's the key to kind of keep an eye on there. As we see on the weekly, now this lower low has taken out the major macro structural support level on the weekly and on the daily. So we'll just have to see how this week plays out and where it closes, and if it continues to march its way downward. So that's what we're looking at on Bitcoin. If we look at the Dow Jones, had a little bit of a bounce here, a little relief, but definitely more downside coming. At very minimum back to this pre-pandemic high level here of 29,000 on the Dow. I think that's just in the cards based on where we are in the monetary policy and the Fed reversing course. NASDAQ pre-pandemic puts that around 98.26. NASDAQ had a little bit of a down day, kind of reversing that bounce from the other day. S&P, you can see where the S&P is heading back to that March 2020 pandemic level as well, which puts it around 35.92. A lot of people have differing opinions on that, but right now the thing is that a lot of people in crypto have never been in or seen, well, a lot of people period out there, a lot of investors out there have never been or seen or invested in a bear market. And I don't mean a bear market in crypto. So everybody who's been in crypto since the beginning, 2008-9, that was after a bear market. That was after one of the biggest economic downturns, global macroeconomic downturn that we've seen in a long time. So ever since then, it's been bull market on because it's been Fed policy, quantitative easing, low interest rate, and the Fed's tried to pull back a couple of times. And the two times that it tried to pull back was 2015, we had the taper tantrum. And then again in 2018, markets threw a fit. So a lot of people that have been investing in real estate, stocks, crypto, whatever it is for the last, really since 2009-10 have seen nothing but bull market conditions, a friendly Fed, a dovish Fed, easy monetary policy, and effective interest rates of zero from an investment standpoint. And that's what the experience has been. So this is very different. This is now risk off. This is, the exact opposite of where we came from. So you have to navigate these markets a little bit differently. And you can kind of see where we're at, how this rounds over into that bear market, global macroeconomic bear market cycle that we're in right now. And it's not about being bearish. It's not about being bullish. What it's about is, I'm as big of a bull as they get when it's time to be bullish. So there are times to be bullish when the global macroeconomic environment calls for bullishness, then it's time to be bullish. And then there's times to be bearish and there's times to be neutral. And it's all based on the economic cycles that you're in, when you want to be bearish, when you want to be bullish, and when you want to be neutral. And all of that really amounts to offense and defense. Right now, we're in a defensive global macroeconomic environment. You got to play defense. Why? It's all about risk management, preservation of capital. Cash is king. You want to have the resources and the funds available to take advantage of the bull market when it happens the next time. And this was our last little drop here, the March pandemic, kind of a black swan. It just boom, straight off the cliff. But this was the 2018 cycle right in here. When the last time the Fed tried to reverse course on easy monetary policy, that was 2018. You see what happens. We still haven't dropped that much. That was a 15% decline on the Dow. We're not there yet. And this was the time previous. That was the taper tantrum when the Fed tried to reverse course coming off of 2008 and 9. And if you look at the Dow Jones, this was 2008 and 9. And let's put this right here. This area looks exactly like where we're at right now in terms of what it looks like, a precursor to a bear market. That is what a bear market kind of looks like. And this looks quick on this chart, but when you look at the amount of time this took from the peak, it was basically almost, well, it's 590 days. So a little over a year, well, a lot over a year, almost 2 years, not quite 2 years. About a year and a half, I guess that would be, is 590 days that it took to reach bottom. But ultimate recovery, and this is what I'm talking about, you want to have the capital available for that market recovery. So if you go from peak to get back to the level that the market was at, you're talking about 1,981 days. So when you think about dollar cost averaging, you want to do that on the way up. Dollar cost averaging on the way down, sure, you can reduce your basis from up here a little bit, but you could be stuck in that for years and not have the money to dig yourself out of that or to take advantage of the next bull market cycle. So you got to be careful where your dollar cost averaging. You want to do that on the way up. Typically, that's a bull market strategy because you're reducing your basis as the market goes up. And in a bear market, you want to buy the dips, sell the rips, buy more, sell, buy more, sell, buy more, sell. So you kind of want to do that. You don't have to get the exact bottom, the exact top. You just got to say, hey, if if the market drops, 10, 15, 20%, whichever it is, crypto can drop more than traditional markets, then it's going to bounce. And if it bounces 10, 15, 20%, just, buy, take some profits, buy, take some profits, that kind of thing versus, buy the dip, market goes up, buy the dip, market goes up. That's a different strategy all in all. And you can see how the wealth that was wiped out and destroyed back in that 2009 bear market. And that's what a bear market looks like. Sure, this was up from here, but it was still down from all-time highs for a number of years. And prior to that, this area here where the market kind of consolidated and rolled over in that 2000, 99, 2000 to 2003 timeframe. And then before that, it was more steady. So these are the types of things that you want to think about. There's a time to be bullish. There's a time to be bearish. There's a time to be neutral. And this is all about playing defense right now, making sure that you preserve the capital that you have made in the bull market, and keep some reserves ready to take advantage of the opportunities that come in these bear market cycles. So those are the things that I'm looking at right now. And anything can happen. So if you look at where we're at in the structure of price rolling over, especially in traditional markets, this looks a lot like those bear market rollover tops that we've seen in the past. You're going to get nice bounces. Bitcoin typically in bear markets past, you're going to get 20, 30, 40% rallies off of the lows as the market continues to work its way down, even like it did last summer before it finally found that bottom. So you got to make sure that you're careful, you're kind of ready for those things, and then make sure you understand what you're investing in terms of some of the DeFi projects out there, altcoins, stablecoins. I sent a little tweet out earlier that I do not recommend keeping your funds in stablecoins right now, just because the two that are left, the two big ones, USDC and Tether, neither one of those are backed 100% with dollars. You can go to their websites, you can look at their attestations, which all that is a statement of an individual based on what you tell them. So that's really all it is. Nobody has seen Tether's bank accounts. Nobody has seen what their commercial paper looks like. Nobody's seen the actual bonds. They just say they have these things, and they open the books that they have, and you can make your books look however you want if you're not regulated, if there's no laws or rules governing that. So that's not to say that I'm sure behind the scenes they're trying to catch up and they're trying to get as much money in the bank as they can, the way that Tether does things. But when it comes time, if there was ever a run on Tether, the reason I say Tether is because they have a lot of their assets. If you can go look at their website, showed it the other day, you can see what their holdings are. And if they have to liquidate, they're not going to get 100%, on the dollar of everything they liquidate. They're going to get pennies on the dollar for those commercial notes, for their treasuries, for their bonds, because there's open markets for those. You buy them at a discount. So if you sell quickly and you don't hold them to maturity, you have to sell them at a discount. So they're not going to get dollar for dollar if they have to liquidate. And that's why it depegged the other day, because they had a run and they don't have the cash. So they had to, work out the way they work things out at Tether, which is to print, buy assets, sell them to, generate currency to cover redemptions. They don't pull it out of the bank because they don't have it in the bank. And if they did, they would open their books, they would show their bank accounts, and they would prove it. And, they're not doing that for a reason. So that's not to say they won't fix it, but there is a risk there. USDC, they're kind of in the same boat, except they are opening up a little bit of their books to the SEC. They want to go public. They're in the United States. They have laws that are governing things in the United States, but they're not a public company. They're a private company, so they can still do some things that public companies can't. So there's still risk with USDC because, again, they're not one-to-one. They don't have a dollar in the bank for every dollar of USDC they issue, which is what they really should have. A stable coin really should be the dollar is in the bank for every dollar that's in circulation. So if somebody wants to redeem that, dollar just comes out of the bank and they just earn yield on the interest-bearing accounts that they have at the bank. I mean, that's the way it should be for stable coins because, people are trusting them that they have that money whenever they want it. And the other thing is stablecoin is a currency, and you saw a lot of the exchanges issue the disclaimer a couple of weeks ago. If you didn't, their disclaimer was, in the event of a bankruptcy, the currencies that are held on the exchanges, stablecoins, if they're not in your wallet, if they're on exchanges, it becomes property of the exchange and can get tied up in a bankruptcy. Your cash funds can as well. But in the US, most of the exchanges in the US, you can just use currency. You can use your debit card, credit card, bank account to fund your account, just trade in and out of cash. So that's what I do. I don't use stable coins, never have, never will. I just use cash in and out. And, in the United States, all transactions, all gains are taxed, whether it's a stable coin transaction. If you're buying Bitcoin, selling, going into stable coin, back and forth, that transaction is taxed as a capital gain, just like going into cash. So it really doesn't make a difference. It's seamless. It's easy. That's the way I do it. Obviously in the early days, most people were trading in and out of Bitcoin. So Bitcoin was your stable coin, and you would hold Bitcoin and trade in and out of altcoins with your Bitcoin. Then that arguably could, avoid a capital gain situation. The United States, I'm not sure what the case, there probably is no case law on it, no ruling from the Department of Labor on how that's handled as tax. But stablecoin, gains in and out of stable coins between cryptos are, handled as taxable gains, just like using cash. So there's no difference there in that regard. So, this is the time to be defensive. This is the time to keep an open mind, watch for the warnings, keep an eye on these companies, watch these stablecoin pegs, make sure you're just watching that. And if you're in stablecoins, just, be safe, be careful, and just, you want to protect yourself, because we saw what happened with Terra. Everybody thought that was safe and fallible. Not everybody, but a lot of people. There were a few voices out there that were saying it was unsustainable, it was going to crash. And as soon as I saw them buying Bitcoin, that's when I said, this is not going to work. That's just what they were doing. It shouldn't even be legal. And if they were in this country, it wouldn't be. And there would be people that would be potentially going to jail over this whole thing, but they're not in this country. So they're not in the United States. So they're outside of, rules and laws of the land. And a lot of people ended up getting hurt with that. Again, it's all risky. You're taking risk, you're making your own decisions, and any investment is risky, and you can lose your money in any investment, whether it's real estate, business, stocks, it doesn't matter what it is. That's why you could make a lot of money. It's all about risk reward. So just be safe out there, be careful, make sure that you play defense. This is a defensive market. This is not an offensive market. There will be a time to be bullish. I'm the biggest bull of them all when it's time to be bullish. And I've been through all of the cycles, up, down, bull, bear, and neutral. Right now, it's not neutral. Right now, it's defense. It's time to protect your assets, cover your assets, and be ready to take advantage of the bull market. And I will give you the signal when it's bull market on. And actually, I won't give it to you. The Fed will. When the Fed pivots, when the Fed reverses course, when they can pivot and they can reverse course, that's when it's going to be bull market on. And when that messaging starts coming out of the Fed, it'll be pretty evident, pretty clear, because the market will get the biggest bounce you've seen since the March 2020 recovery and the 2009 crash recovery. Study those, and the 2018, after the taper tantrum, study those bottoms, see how fast the markets recovered. And it was all about the Fed coming out. In 2008 and 9, the Fed came out, started the asset purchase program, started QE, lowering interest rates. Markets, were off to the races. It was straight up from there. 2018, after the Fed reversed course, same thing there. And it's going to happen again. Well, March 2020, we saw what happened there when the Fed jumped in. It'll happen again here when, once the markets reach their final capitulation point, which they have not done yet. The Fed will get pushed to a point, if they can, based on inflation and, election cycles, all that kind of stuff, and how bad things get. That will be bull market on. The signals will be there, and I will be here to let you know. So these are the things I'm looking at, and I will see you in the next video.